I'm Josh Christensen.
And I'm Kristin Toussaint.
And this is Most Innovative Companies. On today's episode, Andrew Ross Sorkin on his new book, 1929, Inside the Greatest Crash in Wall Street History and How It Shattered a Nation.
What happens in the past, unfortunately, seems to repeat.
Kalshi co-founder Luana Lopes Lara.
Over 2 million new accounts, number one in the App Store, all of those things that really, like, when you start a company, that's what you dream with.
And as always, keeping tabs.
With this fake headline that said, when you're the most self-obsessed tone-deaf person on earth, other moms tend to shift focus to their actual toddlers.
But first, here's the download, the news you need to know this week in the world of business and innovation.
Last Saturday, Venezuela President Nicolás Maduro was captured in a U.S. military operation and brought to New York. On Monday, he pleaded not guilty to federal drug and weapons charges in a Manhattan courthouse. After the capture, Trump announced a plan to take control of Venezuela's oil industry and ask American companies to revitalize it. He also posted on Truth Social that the country would be, quote, turning over between 30 and 50 million barrels of high-quality sanctioned oil.
Well, that's sweet, high-quality sanctioned oil.
Stock prices for Chevron and Exxon rose early this week following these announcements, though experts believe it could take years and major investments for oil production to increase due to access to Venezuelan reserves.
Yeah, I don't know how else to talk about this story.
No.
We're finding the business angle in here, but No one needs our geopolitical takes.
The oil industry stuff is interesting. I mean, currently Venezuela produces less than 1 million barrels of oil a day.
Yeah, there's also a number. I mean, you cover these industries quite a lot. There's also that number floating out around, Venezuela has the most oil reserves in the world. But that number is kind of just based on what Hugo Chavez and Maduro, said was there.
Yeah, a lot of the oil industry stuff seems based on vibes because the stock prices went up, but then analysts were actually saying to sell them because the oil industry has a surplus right now. And so there's a little bit of a disconnect.
Yeah, it's not clear that it does feel very 2002 in a lot of ways, but it feels very last century's most prized commodity is being talked about in these terms. But let's talk about the actual most prized commodity in today's economy, AI chips. So Nvidia officially launched their new Rubin computing architecture at CES this past Monday. The company's CEO Jensen Huang said this new architecture and line of chips will be more powerful than the current Blackwell architecture and run on significantly less power.
Pharmacies across the U.S. will now offer a pill version of the popular weight loss drug Wegovy. Novo Nordisk announced Monday that the pill is now available and out-of-pocket costs would start at $149 a month. A recent survey estimates that 1 in 8 Americans are already taking a GLP-1 medication for weight loss.
If there's one thing I know the Fast Company audience loves, it's Wegovy. It's GLP-1s. Just look at
Can't
our...
escape it. It's everywhere.
No, we can't. We can't. There's been a new quantum computing breakthrough. On Tuesday, the quantum computing company D-Wave announced what they called, quote, an industry-first breakthrough, which essentially makes the so-called gate model quantum computers less complex and use less resources. This eventually will allow the quantum computers to be more scalable and potentially commercial. We had a great feature on quantum computing, basically explainer, in our spring issue,
I was going to bring that up because for anyone who doesn't understand what any of those words mean.
Which is me.
That is
me.
a really great deep dive on explaining exactly what quantum computing is.
By friend of the show, Harry McCracken.
For those of you still on X, you might have noticed a pretty disturbing new trend occurring. People have been using Grok to create lewd images of women and young girls without their permission. Regulators and officials have started to raise alarm bells. European Union spokesperson Thomas Renier said, quote, "This is not spicy, this is illegal, this is appalling, this is disgusting, this is how we see it, and this has no place in Europe."
Continued descent to new lows.
I would hope it has no place here, too, but regulators haven't really been talking that much about it stateside, it seems.
No. I mean, the EU is historically the most adversarial towards the big tech companies, but I haven't really seen many U.S. officials talking about this. Maybe that changes by the time this comes out, but
I would hope so.
Yeah, it's pretty gross. And finally, Warner Brothers again rejected Paramount's latest takeover bid and told shareholders Wednesday to stick with a rival offer from Netflix, a rival and original offer that they accepted from Netflix. The board of directors called the offer too risky because it's largely financed by borrowed money. Apparently, the quote, this is my favorite part. This is from before the holiday break. The irrevocable personal guarantee from Oracle founder Larry Ellison, who is the father of Paramount CEO David Ellison, to back $40.4 billion in equity financing, didn't do enough to sway the board.
Wow, $40 billion doesn't sway.
I mean, this is this peak Nepo baby culture?
That connection is wild. I wonder, I don't think I was totally aware of that right away.
Oh, yeah.
Yeah.
Paramount is basically Baby Ellison's sandbox to do what he wants. It's like, please, Daddy, let me make a media conglomerate monopoly. Coming the next Timothy Chalamet Wonka sequel that has young David Ellison. And that's the news you need to know today. So, Kristin, if you could bet on something that not even Polymarket or Kalshi can place odds on, what would you bet on?
Well, I think we've seen with those platforms that you can really bet on anything, which is wild. Someone made a bet about Nicolás Maduro being captured.
Yeah, raked in about $400,000.
Which, who even knew to place that? That's a little bit questionable. Oh, that is a good question. I feel
like it has to be something like real niche to your like family or friend lived experience.
Like, will I wake up before my alarm clock tomorrow?
Yeah, like I want to bet on like an over under how many glasses will break in the dishwasher after my wife loads the dishwasher because she is a maniac.
That's tricky. As someone who didn't grow up with a dishwasher.
She loads with reckless abandon.
Yeah.
She's like, it can fit.
I appreciate that. Yeah, you're just going to try to get it all in there. How about you? What else would you bet on?
Oh, God. Oh, man. I mean, I do love a good sports bet. I do a little bit of like sports gambling on like the DraftKings or things like that. I want to zag in another direction from people being like, we can't have prop bets. I want even more ridiculous prop bets that are completely not gameable, like just like act of God events. You know what I mean?
Yeah, no one can rig this, but just like, will someone, I don't know, trip or something?
Or like stuff that happens like in the crowd. You know what I mean?
That's a good one.
That's probably riggable too. These are all probably riggable. Yeah. That's the problem. That
makes it feel like we're just living in a simulation, doesn't it? It's like anyone can do anything at any time.
Yeah, more or less. It's great. Well, anyways, we're talking about this because later on today's episode, Ainsley Harris is interviewing the co-founder of Kalshi, one of those prediction markets we just mentioned, Luana Lopes. So stay tuned for that. But first, 8 years ago, Andrew Ross Sorkin, who you know from Squawk Box, which is my favorite name for a business program, other than MIC, of course. And then you also know him from New York Times Deal Book. Well, he started writing a book about the stock market crash of 1929. He told us when he started writing, he thought he was writing a history book. But today, the story of 1929 bears some alarming similarities to our current reality. He spoke with Fast Company editor-in-chief Brendan Vaughan all about his new book and the state of the economy. Here's that conversation.
I'm going to give you a big fat meatball to get us going and set the table here. I promise my questions will get better. But I do really want to set the table for the audience. Why should someone who cares a lot more about the future than the past read 1929 today?
Oh, goodness. Because in truth, what happens in the past, unfortunately, seems to repeat. And when I began this project, which was 8 years ago, I really thought I was writing a book about the past. That's what I thought I was doing. And the truth is, so much of it feels like it's happening right now in front of us. And that's probably the biggest answer, which is, I think if you're trying to even understand this moment, oddly enough, which, again, was not my intent at all, but if you are trying to understand this moment, whether it's AI and this AI bubble, whether it's the gamification of the stock market, prediction markets, democratization of finance, and all of the things that are happening with crypto, while those things weren't happening in 1929, so many things that looked almost identical to it in their own way were.
When did you realize in the project, you said you started 8 years ago, when did you realize, oh, I'm writing about right now as much as I'm writing about back then?
I would say, do you remember the GameStop sort of saga?
Sure. Yeah.
The memification of the stock market? I think that was really sort of a wake-up call for me where I said, oh my goodness, this is actually very similar in terms of just the FOMO, the psychological reaction that humans have to wanting more, to following each other, some cases like sheep. I think that moment suggested to me that, oh, this was a story that was really not about history at all. And then as I continued writing, all of a sudden, more recently, we had things like tariffs. Well, there were tariffs in 1930. The sort of democratization of finance, crypto sort of language was almost identical to the language being used back then. I think it was a number of those type of things. A lot of the debate even that the Federal Reserve has been having about lowering or raising interest rates and how do you stamp out speculation, but how do you not do it without screwing up unemployment or employment? It was all of that.
I really enjoyed the story of the book, not just the implications of the book. Obviously, you want to come away from reading something like this with a lot to think about and a lot to compare the past to the present, obviously, as we've been discussing. But it's also just a great yarn, a lot of narrative propulsion, a lot of narrative force, great characters who really come to life. I found myself kind of mapping the book and what I was reading against a lot of pop culture that has come out in recent years, depicting this period of time, kind of allowing it to be more vivid in your mind as you're reading, which was just kind of a fun exercise. I don't know that others did that, but I found myself doing that. I'd love to hear, you're a financial reporter, you know, you've made your bones with DealBook and with Squawk Box and Too Big to Fail and Billions and all the other projects that you've been involved with. And of course, Too Big to Fail is also a great narrative that has characters and scenes and all of the great elements of storytelling. But how did you balance the duty that you felt to tell a great story and entertain your reader with these big lessons that you were incorporating into the telling, particularly when you think about that dynamic we already talked about, where you thought you started out doing one thing and then wound up doing something else?
So here's the crazy part. I don't think I was ever really trying to tell a big story. I think I was trying to tell the story that you just referenced. I was trying to tell the story about the characters, the people.
Okay.
That is the entirety of the book. It's supposed to read like a novel. It's supposed to feel like you are in it. You feel these people. And how did people think in those moments in real time, contemporaneously? And I fell in love with these characters, not because, you know, some of them do terrible, terrible things, but they were such rich, interesting people who were doing super important and oftentimes influential things that changed America. And so to be with them, to get the reader to feel like they were in the room as these conversations were happening, as these decisions were happening, that was really the whole story that I was telling. It just so happens that a sort of second order effect is that so many of the things that they were doing happen to look like things that are happening now. But in so many ways, I mean, I used to have debates with my editor about this. Should we at some point stop the action and tell the reader, like, this is what's happening in 1929 is like this thing that's happening now? Or
I appreciated that you didn't do that.
And we never did that.
Trust the reader's intelligence to draw those lines themselves.
And because my view is some people will come to the book in a certain way and project certain things on the characters, and other people project other things on the other characters. I once saw, I think it was an interview with Quentin Tarantino, who had, I'm going to screw up the line, but it was something like, when a movie's over and the lights go up in the theater, he wants everybody to think they saw a different movie.
Yeah, that's great. Yeah.
And I kind of feel that way about this book, and actually about Too Big to Fail too. Like, if you just tell the story of all of these wild characters doing all of these wild and crazy things, you as a reader hopefully just go along for the ride. But as you're going for that ride, I imagine, I hope that it makes you think. Invariably, and I think I knew this even 8 years ago, whenever you write a book like this, people are going to say, well, is what happened then possible to happen now? Is that a bigger question today? Yes, I do think, you know, I did an interview with Leslie Stahl when the book first came out. And of course, you know, they wanted to ask the question, are we going to have another crash? And the answer, of course, is, of course, we're going to have another crash.
Right. It's just when. Yeah.
And so in in many ways, I think the story I want to believe is timeless. Had it come out 5 years ago, I think the publisher would have loved it to have come out during the GameStop craziness. I remember the only time I didn't want it to come out was during the presidential election a year ago.
Yeah.
Just because I thought the attention of the country was somewhere else.
Nobody wants their books to come out in the fall of an election year if the book is not about the election or the candidates.
Pretty much.
Issues or whatever. So issues that are much more directly in the political conversation. All right. So let's go back to something you touched on already, which is that the 1920s were this period of intense financial innovation. There were a lot of new products out there, margin lending, investment trust, these kinds of things. Many of these products were legal, they were admired, they were widely adopted before they proved to be very destabilizing in ways that were difficult or impossible to predict. So what does 1929 teach us about the difference between innovation that scales opportunity and innovation that essentially just creates fragility and vulnerability throughout the ecosystem that is, as it gets more sophisticated, gets more difficult to predict?
Okay, so I think there's two things going on in the 20s that are relevant today in the following way. So there's one issue which you could watch all the time and you should watch at every moment, which is just debt.
Yep.
In the case of 1929, it was margin loans, but in the case of 2008, of course, it was subprime loans. You could go through the list. Debt is the match that lights the fire every single time. That's just what it is. It's very hard to actually have a genuine systemic financial crisis without the debt piece of it. The other piece, though, and you mentioned the sort of new product piece of it, is I think there can be great innovation, and there really was. A lot of these new interesting products came to be. But there was such little transparency, such little disclosure. I remember somebody asked me what the prospectuses looked like back then. And I looked at them and I said, prospectus?
Yeah, right.
You'd be lucky if someone handed you a leaflet on the street.
Yeah, two guys having a phone call, was the prospectus, yeah.
There really wasn't, there wasn't an SEC, there was no FDIC, there was no capital requirements, there's no nothing. And so I think one of the great lessons is when you are going to try to innovate and create a great product, and you can have great financial products, they just need to come with some financial disclosures and transparency. And invariably, when people start these new products, they rarely do. And it's only typically when there's a problem that all of a sudden now the SEC, which of course exists today, or somebody else, some other regulatory body stands up, raises their hand and says, excuse me, this doesn't work so well. I think a great example of this, by the way, is SPACs, these blank check companies, which, had a sort of super popular moment just a couple of years ago. Virtually all of them, 90+% of them ultimately failed.
Yep.
And I would argue they failed in part because, and the investors who put their money in lost money because they didn't understand. There was not a lot of transparency about who was the promoter and the sponsor of the SPAC really behind it. How much money were they really making? How quickly could they sell the shares while you couldn't?
Yep.
There were a lot of things that, by the way, but the SPAC idea unto itself is not a bad idea. The concept could work. It just needs to come with a whole lot of guardrails so that the investor class who's backing these things understands all of the rules. And by the way, and it probably wouldn't have been nearly as popular as a result.
Right.
But it could have been a sustainable product. Today, SPACs now have a black eye, a bad name. And so almost nobody does them anymore.
Right. They did not emerge with a great reputation from that. As you said, the overwhelming majority of them ultimately failed. Well, you kind of gave me a perfect segue to my next question, which is that I wanted to ask you about investment pools, which you go into in the book, which is this 1920s Wall Street fad was the word that you used.
Yeah.
Not illegal, underhanded,
Nope.
but not illegal. You made an interesting point that even the people that are following the activities of these pools might not have been ignorant to the fact that they were following an investment pool and that it was really a question of timing, when you get in and when you get out, as you're following the kind of manipulation that's going on as a result of the pool. But let me just ask you straightforwardly, what was an investment pool? And then what are some modern day examples of that kind of engineering, if that's the right word? SPACs maybe are one of those examples.
So an investment pool was basically a manipulation scheme among, back then, a group of elite or wealthy investors who would get together and say, you know what? We are going to run a effort to push up the price of a stock, sort of like what they call today, they call it a rug pull. But you try to press the price of the stock up through, by the way, paying off journalists and putting out rumors, buying up the stock, hoping that others will then buy up the stock on the backside of what you're doing. I mean, pump and dump kind of stuff is what we're really talking about.
Yeah.
And they would get together, they would identify the stock that they were going to go after, and they literally had the equivalent of almost like actors on the floor of the New York Stock Exchange saying, you know, I'm in for 120, no, I'm in for 140, no, I'm in for, but they all were in cahoots with each other, and it was oftentimes being run by the specialist, literally the guy who runs the sale and trading of that particular stock.
Kind of amazing that this wasn't illegal, actually. I mean, given that last part, especially that you just mentioned.
So I think about this all the time, by the way, about why wasn't it illegal? Obviously, with hindsight today, it seems clearly illegal. I think most people who are watching this would say it's immoral, if not something else, and shouldn't be allowed. Having said that, two things that I try to think about a lot when I was writing this book, I try to put myself in the shoes of these people. And the stock market's a very funny thing because people who are trading stocks, especially professional people who trade stocks today and even then, think they're in the business of outwitting somebody else. They believe it's a business of wits. That's the business.
Right.
Because invariably, whoever is buying a stock has to think that they are smarter than the person selling them the stock in that moment.
Right.
And whoever's selling that stock must think that they are actually smarter than the person buying the stock. And so if you think of it in that construct, that frame, I think there's a lot of people who think all of this is just a big manipulation. All of this is just how do I get the better of the other person because I'm smarter than they are. And if I can figure out how to work the system better than they can, I've won the game. It's very interesting to me, despite us here, with hindsight saying, oh, this is awful. And I looked for a very long time. I tried to find some people contemporaneously in real time back in the late 20s who wrote a letter to somebody, anything, some elite person who didn't participate in these pools, who said, I'm not doing this because this is wrong.
Yeah.
That person, at least from my vantage point, I could not find.
Yeah, that's amazing.
And I think about that because, there was no insider trading laws. There was no SEC. There were no trading laws. And so it was so normalized. And I don't say that in defense of these people. I just say that's sort of the reality. And I think sometimes it's important to think about that reality, about why they were doing what they were doing.
Well, I mean, do you feel that mentality was connected to the original reputation of the stock market as this kind of unseemly thing that it wasn't too long ago when people thought debt was immoral, right? Like just debt at all, any kind of debt.
Debt at all.
A mortgage, immoral.
Totally.
In the early days of the stock market, it was not really considered sort of reputable in like a white shoe law firm kind of way, right? So maybe the default assumption that it's all just one guy trying to get over on another guy was just kind of baked into the mindset of those playing.
I think it was baked into that equation. By the way, I think to some degree it's baked into the equation today of not just folks on Wall Street, but think of the whole crypto market. I mean, I know so many people who were involved with crypto, especially maybe less today, but even 5 years ago, 10 years ago. I mean, the amount of manipulation, I hate to say it, that's taking place in that market it's rife.
Yeah, yeah. Let's take a moment to compare today's market, not to 1929's market, but to 2000 and 2001. I mean, there's a lot of conversation about whether today's bubble, you used the word bubble earlier. It certainly seems to be near consensus that we are in a bubble, not total consensus. You definitely, on the AI side, you certainly see people arguing, smart, sophisticated people arguing that this is the real deal. This is not a bubble. These valuations are justified. These profits are coming and are already here in the case of a lot of them. So one of the most common arguments against the comparison to the dot-com bubble, the NASDAQ bubble of 1999, 2000, 2001, is that unlike a lot of those companies, the pets.com, the diapers.com, and all that stuff,
Right.
the companies that are driving the market now are actually making enormous amounts of money, and that therefore this isn't a bubble. Now, lots of those companies, especially in the AI space, other than the giants, are not making an enormous amount of profit yet, even if they're building their businesses and building their client base, et cetera. So what do you think of this comparison in general? And what do you think of this idea that there's this fundamental difference between what we're seeing now and what we were seeing then, to the extent that these companies now are booking enormous amounts of revenue and many of them are making enormous amounts of profits every quarter?
I think there's a little bit of a head fake going on, and this is the head fake. When you and I are talking about big companies that are throwing off enormous profits, we're talking literally about 5 or 6 companies.
Yep.
Some of them are software companies. That could be a Meta, could be a Google, could be an Amazon. Some of these companies we're talking about are hardware companies, obviously, which are the biggest beneficiaries, in Nvidia, for example. But most of those companies on the software side, as you just said, are not making an extraordinary profit doing this. And it disregards the thousands of startup companies that have emerged around this entire space. It also misses the huge capital expenditure that is taking place for these data centers.
Right.
And embedded in that is not just money coming from these big hyperscalers. It's money coming from the energy sector, which obviously needs to finance huge power to make all this work. It's the real estate industry, it's the construction industry, and there's a lot of private credit, meaning loans, margin, if you will, being used to prop up this entire world. That's not to say, by the way, that it has to come to a screeching halt, but it could be that there is a moment at which the market, if you will, says, you know what, these things are worth half of what we thought they were.
Yep.
Or a third of what we thought they were, or maybe 2/3 of what we thought they were. But there could be a recalibration. By the way, we had this even just a couple years ago in the world of entertainment, media, streaming.
Yeah.
There was a moment where everybody was chasing the sort of Netflix fever dream. And then all of a sudden, Netflix's stock fell out of bed. People said, well, we don't know if it's going to grow the same way we thought it was. And then all of a sudden, Disney and Paramount and you name the company, the value of their companies dropped too. So I think there could be a moment at which some of these valuations, which then, of course, inflate other things as well, like crypto. And by the way, there's a correlation between these things in part because so many of the same people are invested in some of these things that you could start to have some breakage. Again, none of this means that we are predestined to have a bubble crash like 1999. And I want to be 100% clear, even though I've said we could have another bubble burst, it does not have to be like 1929.
Yep.
And 1929 was particularly unusual because it was really the first domino in a series of dominoes that leads to the Great Depression, but it did not have to lead to the Great Depression.
Right.
It wasn't that somehow there was a crash in October of 1929 and all of a sudden we had 25% unemployment. It took 3 years and a series of terrible, terrible policy choices by the Federal Reserve, by the President of the United States, and by so many others.
Walk us through that a little bit, because I think, we haven't talked too much. I mean, we're at the beginning of 2026. Your book has been out since October. I know you've done a lot of these interviews, so I've tried to gear my questions a little bit more around what the book can tell us about what's happening now and what might happen in the future.
Yeah.
But this is fascinating, and I think a lot of people in the sort of popular imagination of the Great Depression and the stock market crash of 1929 think that these were one thing happened one day, and then the next day where there's soup kitchens and the lines and all the stuff that you see in kind of black and white in your mind.
Right.
No, that's not how it went. In fact, there were some false recoveries. There was this sense that, we got through it. So walk the listener through that process a little bit and what some of those catastrophic policy and other kinds of errors were.
And by the way, that was another reason I wanted to write this book, beyond just the characters, which was just that I thought there was such a misunderstanding of this period, which in truth, I didn't know the full story either for a very long time until I actually really dug into it. So you have a crash in October of 1929. That is true. It didn't happen just on one day. I think there's a popular perception there was somehow, a Black Thursday or a Black Monday or a Black Tuesday. It was all those days and more.
Yeah.
By the way, interestingly, because I know a lot of your listeners are interested in the world of technology.
Yeah.
I actually think that one of the main culprits for the crash, despite the overvaluations and everything else, was actually technology itself, which was that the technology at the New York Stock Exchange,
the lag, right? Yeah.
was not, it was almost like, think if your computer basically stopped working. That's sort of what happened. And because of that, people started selling stocks almost indiscriminately because they had no idea whether the system worked anymore, meaning they were looking at stock prices that were often 3, 4, 5, 7 hours out of sync. And that unto itself, I think, actually took a lot of the confidence out of the system. So you had this terrible moment in October. You add on top of that the leverage, the fact that so many of the individuals who were playing in the stock market were levered not just 3 to 1 or 2 to 1, but 10 to 1. And all of a sudden, they're getting calls, margin calls, meaning that they're having to pay back not just the money they've lost, but the money they've borrowed, which means they're now mortgaging their homes, selling their homes, losing their jobs in some cases. Interestingly, the stock market only was down. Again, I think most people don't even know this. The end of 1929, the stock market was only down 17% for the whole year.
Yeah, people definitely don't know that. Yeah.
But most people couldn't make it to then. It wasn't like they could benefit from the run-up of the stock again, even to get down 17% because they had lost so much already, then they had owed so much to the bank. So you have this sort of confidence that gets sucked out of the system. Then you have a Federal Reserve that wants to pump money into the system but feels like it can't for a whole host of reasons, one of which is the gold standard, which effectively prevents it from printing money, which we do today. But there was a big debate about that, which ultimately gets resolved, and we get off of the gold standard. So we can print money, which is what we do today. You then had the president, in this case, President Hoover, decide he wants to, like President Trump, implement tariffs, what was called the Smoot-Hawley tariff program in 1930.
Yep.
And he did that because in 1928, when he was trying to get himself elected, he wanted the farmers to vote for him. He was so desperate for the farmers to vote for him that he had said, look, if you vote for me, I'm going to do this. And he felt that he needed to make good on his pledge, despite every economist in the country telling him, you're absolutely crazy. This is insane. You can't do this.
Right.
So you have this sort of series of these dominoes at a time, by the way, the market is also going up, it's going down, which, by the way, was its own head fake for a lot of the time for a lot of the policymakers, because they're looking at the stock market thinking, well, is the stock market the real economy? What's really happening here?
Yeah.
And then by 1932, you have just bank after bank after bank effectively going out of business, and the Federal Reserve and the government being unwilling to do anything about it. There's no FDIC insurance, so everyone's now rushing to the banks. Again, now the confidence is getting sucked out of the system. And then you're talking about 25% unemployment. Then you're talking about 9,000 banks going out of business. But again, all of the things that happened after October 1929 didn't necessarily have to result in the sort of horrific outcome that it did at that point.
So let's bring that up to the present day. So, if a financial shock were to hit in the next few years, and, not trying to draw a comparison politically or in any other way between today's leaders and Herbert Hoover and the leaders of 1929. But when you look at this, where do you think we would be in okay shape or even good shape when it comes to government response to a crisis? And where do you think we would repeat the same errors?
Okay, so here's where things get tricky. You're asking a very tricky question. I actually think we have learned a big lesson. And one of the lessons, and we saw it actually in real time after 2008, and we saw it again in the pandemic. One of the great lessons of the financial panic crash of 1929 was, and by the way, Brendan Bernanke, who was the chairman of the Fed in 2008, learned this because he wrote his thesis on it at Princeton. When you have a crash and you have a crisis, the answer is to flood the system with money. You have to print money. You have to pay people, even if you take on extraordinary amounts of debt. That is the way to plug the system. That can put a floor on things. And you saw Bernanke do that after 2008. By the way, you saw Jay Powell and Steve Mnuchin during the first Trump administration do something similar during the pandemic. Okay, so we do know what we're supposed to do. At least we think we do, because that's what the newest playbook looks like. And we've seen it work. The one piece that is sort of the wild card for me, it's like the ultimate yellow card, red card that I just don't know about, is for many years, I think we've all thought wow, this country, the US that is, has an extraordinary amount of debt, $38 trillion. At some point, don't we think the bond market is going to punish us for having too much debt? That's what we've always thought.
Yep.
And for whatever reason, the bond market has not punished us yet. And so the one piece of this that I'm not sure about is if we continue to keep running the same playbook and we get to one of these terrible moments and we decide, throw caution with the wind, we'll add another $5 trillion of debt to the plan or whatever it is there some kind of red line? Or is there some invisible line we don't know about that turns into a red line?
Yep.
Where the bond market stands up and says, no, we're not doing this anymore, folks. You want to get a loan from us? We'll loan you money, but it's going to be at, these usury rates, in which case all of a sudden you're going to have an austerity program in the country. And, you could have a real sort of vicious cycle rather than a virtuous cycle. And so that to me is sort of the scary set of outcomes that I just don't know about.
I wanted to ask you about one criticism of the book. The book was very well received. Congratulations, well reviewed. There was one critique that you see, which is that John Kenneth Galbraith wrote a famous book in 1955 called The Great Crash, 1929.
Yep.
And there was a fair bit of criticism. Fair bit is maybe strong. There was, I saw it more than once. Criticism that your book was, too close to comfort to a rehash of that book, kind of the similar narrative structure, lead up to the crash and the immediate aftermath, not a dissection of the Great Depression, but kind of a story that tells the tale of what led to it.
Right.
And that analytically, it wasn't additive in the extent that it completely rethought what this all meant or whatever. So just wanted to get your reaction to that, whether you think that's fair and what your response to that is.
I haven't seen the comparison so much to Galbraith's book, which is a great, great book. And I think he did an extraordinary job. And that book, in a way, turned out to be a treasure map for me. I will say, and the reason, maybe I have to go read one of those critiques. What I do recall about that book is there's very little. I mean, I don't believe that Charlie Mitchell plays a huge role in that book at all.
Okay.
I'm not even sure there might be more than a couple of references, even passing references to Carter Glass, who's the other main character in this book. I like to believe there's a lot of unexplored material. I know there's unexplored material in the book.
Last question.
Please.
If you were writing the opening chapter of 1929, except that it's for now, it's the mid-2020s.
Yeah.
What would you be watching most closely right now? Just as a journalist with an eye for scene and the telling anecdote or the telling set piece that really kind of sets the stage for the moment that we're in. And obviously there's a little bit of crystal balling going on in answering this question. But as you're not sort of chasing headlines or whatever the kind of conversation online at the moment is, but what is the thing that down the line is going to represent what is happening right now? What do you think might be?
Okay, so I'm going to tell you who's in the scene. Can I tell you who's there?
Yeah.
So I think that Sam Altman is going to be on the telephone, a 3-way conversation, maybe 4-way, with the President of the United States, Jensen from Nvidia,
Yep.
and maybe Jay Powell, and maybe a bank, maybe Jamie Dimon, but maybe it's somebody who's maybe one of the big private lenders. Mm-hmm. Maybe it's somebody in the private credit space.
Okay.
And they will have just learned that somebody is not going to be making some payment. There's some payment that's not being made on some data center somewhere.
Data center debt or
somewhere.
Yep. OpenAI's, ChatGPT's revenues didn't grow it enough to pay off that.
And by the way, it may not be that it's OpenAI itself that has the problem. It may be actually that it's a smaller company that's having a problem, or that it's one of their competitors that's having a problem. But because of that, it's raising a new problem for OpenAI because they require the need to keep raising new cash.
Right.
And in this moment now, it's about to get very hard. And so all of a sudden, there's some kind of big conversation. Should the government be stepping in potentially to invest in all of the AI companies? Can that be done under the construct that this is a national security issue and we need our national champion? I don't know what it's going to be, but I think something will have just happened and there'll be some kind of 3 or 4-way phone call. Maybe it's happening on the patio at Mar-a-Lago. I don't know, but that's be the opening of the book.
Is this book called 2026, 2027, 2028?
Maybe it's called 2029.
Andrew Ross Sorkin, thank you so much for joining us on the Most Innovative Companies podcast. This was a lot of fun. Really appreciate you taking the time to join us.
Thanks for having me.
We're going to take a quick break, followed by Fast Company's senior writer Ainsley Harris's interview with Kalshi co-founder Luana Lopes Lara. For many people, the first time they thought about Kalshi, a prediction market where you can place bets on the outcomes of sports or politics or culture or weather or basically anything else, was after a video clip of its co-founder, Tariq Mansour, went viral in December. In the video, Tariq was speaking at the Citadel Securities Future of Global Markets conference, say that 3 times fast, and he's asked why he thinks prediction markets will be bigger than the stock market. This is how he replied.
Kalshi is everything in Arabic. The long-term vision is to financialize everything and create a tradable asset out of any difference in opinion.
Prediction markets are polarizing, to say the least, but they will inevitably become more prominent parts of our financial and media ecosystems. Case in point, Kalshi recently struck a deal with CNN, which you'll hear more about in this segment. Fast Company senior writer Ainsley Harris sat down with Kalshi's co-founder and COO Luana Lopes Lara about the Kalshification of everything.
Luana, thank you so much for joining us on Most Innovative Companies. We're so excited to have you on this episode, especially because it's been such a big year for Kalshi. And as we kind of come into the end of 2025, as we're recording this, it seems like a great time to reflect. So thank you so much for being here.
Thank you so much for having me.
To start, I thought we should just dive into some of the basics for folks who aren't familiar with a prediction market. What is one, and when did you start Kalshi?
Kalshi, what we are is we're a financial market, but instead of trading stocks, crypto, or bonds, you're trading shares of what's going to happen in the future. So basically, you're buying and selling contracts of who will win an election, or what will happen to climate change, or what will happen to interest rates, basically anything that can happen in the future. And a very interesting characteristic of these markets is because markets are amazing at pricing things, you get the best forecast about what's going to happen in the future. And this data can be used to forecast what's going to happen in the world.
And you and your co-founder met at MIT, I think. Is that right?
That's right. We met at the very start of school. And actually, I was very nerdy in school. So I would sit always in the first row in the middle and try to get all the A's I could get. There was one specific office hours that he wanted to sit next to me to ask me questions. And then we started being friends from there.
I'm curious, you guys now have been working together for a long time and had a lot of ups and downs. What do you think makes your partnership work? Some co-founders don't always get along, but you guys seem to have figured out sort of some kind of secret sauce.
That's a great question. I mean, we have a lot of very similar characteristics. We both come from the same background. We studied CS and math. We both love finance and worked in finance, but we're actually very different in a way that Tariq is very good at sales and the more external part of the company, which is what he does. And I run the company internally, and I like and am better at the kind of operational side and product and on the engineering side. I think with co-founders, it's always, what I say is a lot simpler than people think. You want someone that you can stand being with for 16-hour days for many, many years, and someone that you actually respect and admire, because if you do that, you're able to actually go through a lot of ups and downs. I'm very lucky because Tariq is one of the most resilient people I know. And Kalshi has been a very, very hard company to start and to build. And having someone that wouldn't give up as a co-founder is a very important part of it.
Yeah, obviously, I think a huge part of that challenge was getting regulatory approval, which took years. Walk me through a little bit of why it took so long to get that CFTC license, and also why you decided that route was the route that you wanted to pursue.
I'll start by the second part. So for us, the idea of Kalshi really came from when we worked in Wall Street. So what we realized that most trading happens when you have some idea about what's going to happen in the future, and then you try to put that in the markets, right? So you believe I don't know, Brexit's going to happen. So you try to short the pound, they go long some German stock, or you try to build a portfolio that mimics what you're actually trying to get exposure to. And what we wanted to do is create an exchange that you can actually trade on what's going to happen in the future directly. Because a lot of times, even though you're right about your thesis, you lose money in the markets. And what we wanted to do is create a market that wouldn't be the case. Because we came to the prediction market idea from the finance angle, doing it the right way, doing it in a regulated way, which is very important, right? Like we wouldn't be able to get Goldman Sachs to be trading on Kalshi if we were doing an offshore, illegal, whatever platform. So for us, it's like, this is the elephant in the room. This is the most important question. Let's go and get regulated first, because if we don't, it doesn't really matter. We're not going to be able to get as far as we wanted to go. Of course, the tricky part is prediction markets were illegal in the US. So we needed to convince the government to allow us to do it. But for us, I think at the time, we were very naive and very stubborn. We thought that these are clearly good for the world. We should be able to convince the federal government. It was very, very hard, like 3-year journey really to get regulated, to get these legalized and then become a futures exchange in the US. And, we did Y Combinator. So it's very usual for all of our peers or whatever in YC to be like, we're growing 50% week over week and all of that. But our story was we talked to more lawyers and we talked to more lawyers. And for 3 years, we didn't launch a single product. And even after getting regulated, it was a continuous battle for many other years up until the end of last year that we really won a lawsuit that really put us in the it was a lot of precedent, opened a lot of precedent for a lot of the way we operate nowadays. So
walk me through a little bit about what's challenging there. I mean, I guess my thinking is that it seems like one of the challenges would be that you guys want to have thousands of different things that people can put money down on, right? Like you don't want just one trade available to folks. And the way the regulators work, I think they often want to sort of review things, a derivatives model in a particular way and sort of approve things case by case. Was part of the challenge there that the scale that you guys wanted to operate at was sort of different? And the speed that you wanted to operate at was maybe different than a traditional derivatives market?
I think there's two parts to that. So technically, in the regulation, you're supposed to be able to list any market as a self-regulated entity within a day that you want to do it and you send it to the government. But I think the problem that we were encountering is that actually the government wasn't following that law. They wanted us to give over 2 weeks of warning, and they were blocking a lot of things that weren't clear with the regs that we thought we clearly should be able to do, and they didn't want us to do. We are fighting to get product market fit, and the regulators fighting us to not get product market fit. And it's just the way that we describe it is like if you think you're a horse, like a startup is a horse, and you're trying very hard to make progress, but we are a horse that actually has an extremely heavy carriage behind us, trying to pull us behind and try to get everything that, to really just make us go a lot slower. But looking back now, I think it's one of the things that made us a lot stronger as a company. And I think that's a positive at the end of the day.
Yeah, it feels like this moat that you've built in a way.
I do think it was a moat for a long time, but we never thought about that as our moat. We really think product, liquidity, markets, all of that really is our moat. But the ability to operate very fast and list a lot of markets is one of the reasons we did the election lawsuit. Obviously, for background, we ended up having to sue the government to allow ourselves to offer markets on the elections. And we wanted, obviously, the elections were very important, but with that, we also knew we would get the precedent to make sure that the government would start applying the law with all of those things.
Yeah, for folks who weren't following the news, walk us through a little bit. I mean, that election moment was such a huge moment, and then ended up being a moment also where, suddenly, Robinhood is offering this stuff, and it was like a domino effect. Why was that so important, and what also was attractive to users about sort of that opportunity to trade?
Well, the election market has always been the holy grail of prediction markets in a way. It's the dream market for almost anyone that really loves prediction markets, because it's where you see the value of these markets really at its best, right? It's you need unbiased, real-time, truthful data about who's going to lead the country, and not just any country, the most important country in the world. And it's very hard to get that data, right? Polls have failed us miserably. It's very hard to just try to find another alternative way. And markets are amazing at getting that data, right? Because they're amazing at aggregating information and incentivizing, bringing good information. So for us, it was we need to do this market. But we started talking to the government about it actually in 2021, I think, right after we got regulated, trying to do it. We engaged with them for a year. on that. And then after that, they said no. We engaged again, got no again. We tried 3 times through the normal process before we decided to sue them. But in our head, the decision to sue was clear. These markets are just too important. And because they're so important, someone needs to bring them to life. Someone needs to actually bring them to a safe, regulated exchange. And you knew, again, that we were very much right on the law. So it was a very long process. We actually ended up only winning the lawsuit 1 month before the election. And it honestly, like the day that we got the news that we had won was like one of the best days of my life. It was insane. Like everyone in the office was crying and screaming, and it was amazing. And it was an amazing month, obviously, because I think we've never worked so hard in the company as much as that. We got over 2 million new accounts, #1 in the App Store, all of those things that really, like, when you start a company, that's what you dream with. But on the other side, after the election was done, everyone looked back at the power of these markets and were like, well, that's right. The polls were saying it was 50-50. It was very hard to know who was going to win. But our markets were saying 65% Trump pretty much the entire time. And with that, I think just a lot more people started understanding prediction markets. It's almost like a vindication moment. It's like understanding prediction markets and understanding the value that they bring. And then after that, I think it was a lot easier to explain to people what we were doing, why we were doing it, and all of that. One of my biggest learnings since I started Kalshi is that I thought people understood probability a lot more than they actually do. And
not everyone studied this at MIT, I guess.
Right.
Yeah.
I guess I did have a very sheltered upbringing in a way. But in a way, it's like 60% chance, right? When people see 65%, it doesn't mean 100%, right? 65 means it's basically, if you think about a coin flip, that it's slightly biased. If I told you today, okay, if there is 35% chance if you leave your house, you're going to get hit by a bus, you're probably not going to leave your house, right? Yeah. And that's kind of what people didn't realize at the time, that 65%, it's obviously more than 50, but it's not 100. And what the markets are very good at is actually giving the probability distribution of what's going to happen in the future. But the markets are not wrong. Like if Kamala had won, there's a 35% chance that Kamala would have won anyway. But of course, in our heads, we were very worried about that outcome because we thought that after learning that I think people have a very hard time understanding probabilities, we knew that if the 35 had happened, we would have gotten a lot of blowback of like the markets are wrong and everything like that. And it would have taken so much more time to educate people to get there that at the end, I think it is good that everyone thinks that the markets were right, even though they would have been right anyway.
Yeah, no, that makes a lot of sense. As you now think about sort of the business that you're building, you guys have a few different pieces of the business, and that sort of direct to consumer one is obviously the one that's gotten the most attention. Break down for us, like how that business works, how you make money and where you're seeing the most interest right now from people who are trading.
Kalshi at its core, we are an exchange and a clearinghouse. So you think about it as if you took event contracts and prediction markets, but you actually think about the stock market, we would be like the New York Stock Exchange. The difference is that we actually also have an app and a website that you can directly trade through the exchange, but you can also trade on Kalshi through brokers, through an API, through a lot of other different ways, because again, we're an exchange and there's a lot of just distribution strategies that we use. The two main ones are, of course, our direct app and website, which is growing a lot. And we're very excited about that because it gives us the opportunity to really invest in the best prediction market experience, not as part of another app, but as like, what is the actual ultimate prediction market trading experience? But the second part of it really is for brokers. And that's a lot of where our growth has come this year. So we have partnerships with Robinhood. We announced yesterday Coinbase, Webull, PrizePicks, and a lot more coming. So you can go to those apps or those websites and those platforms and trade on Kalshi event contracts through them. How we make money is we take a transaction fee, like every time you trade on Kalshi, doesn't matter where you trade on.
Yeah, so it's the same business model essentially, despite across the different distributions.
Right.
I'm curious then, how are you thinking about, I guess, sort of your priorities, I guess? Are you happy to see trading volume anywhere, or do you feel like, you want to be, as you're, the person thinking about product? Yeah, I mean, you guys have just raised a lot of money, so maybe you don't have constrained resources. But yeah, there are obviously trade-offs around whenever you're partnering with folks versus investing in your own app experience. I'm curious, like, how you're thinking about that right now.
A core part of Kalshi is that we want to stay very nimble. Like we have a way smaller team. Like we are, I think, are now 100 people, even though we've raised a lot of money. It's very important for us to, stay nimble because I think that makes us move a lot faster. So being resource constrained, we think is a good thing, actually. In our head, we try to think about being resource constrained. But I totally see what you're saying. Like for example, is one side of the business cannibalizing the other in what to focus on, and are we splitting resources? The way that we think about it is actually everything is very additive in a way that actually having more brokers brings more users and more demand, which means more market makers are going to want to come to trade against these users. With more market makers, there's more liquidity. With more liquidity, we can acquire more brokers and also more direct customers. It just kind of feeds the flywheel. So we think everyone trading on Kalshi, doesn't matter where they're coming from, actually adds to our flywheel and to our growth. So now we're doing over $1 or $1.5 billion traded a week. And it's very important for us to keep a diversified distribution method. And that's kind of like how we're thinking about going international as well, to bring international partners and all of that. Because our goal is to become the biggest derivatives exchange in the world. And to do that, we just need to have basically anywhere in the world and any platform you want to use to trade on Kalshi, you should be able to do that.
I'm curious then, I'm sure you guys are thinking about this a lot. There's this question of like when markets are appropriate. For example, I think after Charlie Kirk was killed, there was a market about whether he might run for office that was taken down. And, I feel like, if you're related to someone who's a political figure and there's a market about, whether they might die in office or something like that, there are obviously like these ones that are more sensitive. And I'm curious like how you're thinking about that, or what the learnings were maybe, for example, from the Charlie Kirk example.
Right. So we're fully regulated financial market, and we think about all of those things. We don't list any markets related to death, assassination, war, terrorism, or anything that one person can really impact. For example, like if a wildfire is going to come out in California, we actually had no markets associated to that. With regards to the Charlie Kirk example, we actually, for example, have in our rules that if something tragic was going to happen, it would settle to less traded price. So no one would actually make money from that incident, which is exactly what happened. And that's why it's so important to be regulated, so that you can actually have these types of safeguards and rules, so that in this case, like actually no one at all profited from the situation. Because you can think about it as similar also in the stock market, right? Like what happens if there's something with Elon Musk or something with Mark Zuckerberg? And the way that we think about it is actually that we need to have these safeguards in place. That's why it's so important for us to be regulated. And that's why we make sure that in the market structure itself, you cannot profit ever from something like this happening.
On the market manipulation piece, thinking about like someone like Elon, I think right now you see on, if you're on the Kalshi homepage, there's, for example, like how many rockets might SpaceX launch in December? And I imagine if you work at SpaceX, you probably have a very informed opinion about that answer. How are you thinking about that piece of it?
Right. So it's very similar to how the stock market handles insider trading, right? You're not allowed to trade on insider information on Kalshi the same way you're not allowed to do that in the stock market. And we have an entire team in the company that actually is called market surveillance and monitoring, that they are looking at every transaction, looking for anomalies, actually running these investigations. And we're a federally regulated exchange. So if you do something wrong and you try to manipulate the markets here, you're going to go to jail. All of those bad things, the exact same way as the stock market, will happen here. Yeah. On top of that, we also have a lot of trade prohibitions. So, for example, if you are Elon Musk, obviously you cannot trade on that market and things like that. Obviously, I cannot tell you it's impossible to have insider trading, but we have the same level of procedures and protections and safeguards as the stock market. And I think the way that the stock market has evolved to this point in time has built such a resilient program that I think that we've learned a lot from and built on top.
Yeah, no, there's a lot of precedent there for sure. When you think then about sort of where trading is really popular right now, there have been some kind of crazy charts that I've seen floating around social media just showing how enormous the sports volume has been, especially toward the end of the year here. And I imagine some of that is seasonal, and people are obviously watching the NFL and all these other things that are really popular. But walk me through, has that been surprising to you that sports has just exploded in that incredibly dominant way? Or, is that sort of part of the thesis that you expected to see that?
If you asked me this question a year ago, it's all elections. It's like, are you? And I think it's exactly right, because a year ago, everyone thought about Kalshi as an election trading platform. It's only politics. And then this year, everyone's thinking about us as just sports. Well, Kalshi really is like, we want to allow people to trade on anything that's going to happen in the future. We have over 4,000 markets. So obviously, sports is a big part of it. There's a lot of people with a lot of interest there. But there are markets literally, we hope that you can find whatever you're looking for on Kalshi, and we want to add more and more markets there. Look, everyone is an expert on something, and we want to have markets so that people can capitalize on that. And yeah, we're very grateful for the growth this year. We don't obviously growing with the brokers, but also a year ago we had 100 markets. Now we have 4,000. So I think there's also the whole platform is growing as a whole, and prediction markets are really going mainstream and growing a lot this year. And we're very excited about that.
Right now, I feel like if you're using a prediction market for the first time, I don't know, you may not have a good sense of did I get a good price, or was this market, accurate or fair? How do you know, really, right? You're kind of new to all of this, whereas in more traditional equities markets, for example, people are very sophisticated about that kind of thing. Mm-hmm. Do you see that sophistication coming to prediction markets at some point? Break down for me what that implies for you, I guess.
Yeah, that is completely right. I think prices are very important. And the most important thing about prices is liquidity. Do you actually have liquidity to make the order book very stable, very robust, and have a lot of volume in it? That's the tricky part of it. Is you actually get better prices at every point in the day or every point in the night, really 24/7. If you have the best liquidity, you're going to have the best liquidity. And that's why distribution is also so important. To get the best liquidity, you need to have a lot of demand and kind of be ahead of the curve, so that when the market makers and the liquidity providers are deciding where to focus, they focus on where most of the demand is. And that's why it's important to aggregate demand, so that get all the brokers, our direct app, all into one place, so that we can say the party's happening here, the liquidity providers will come. The liquidity providers come, and now they provide a lot of stable and good prices. And then with that, that's kind of the underlying mechanism of what we need for each market. But on the other side is you just need a lot of markets, right? It's not enough to have who's going to win an election. You need to have margin of victory, state by state, county. You need to have a very big suite of products so that people can actually trade on exactly what they want to trade on. And that's actually very complicated to do in a legal and compliant way. And that's one of the operational differentiators that we really have, that we've built over the past many, many years at this point. So I think product is a combination of this. It's the breadth of markets you can trade on, the best prices, the best uptime, and the best liquidity. Yeah. And because we're first to market and we're so ahead right now, we can really build our moat around the liquidity and the demand that we have, and make it the party's happening at Kalshi is going to be very, very hard to try to start another party somewhere else.
Someone from your team is now applying for a CFTC license. I've started a new company, I think the clearing company. And, do you expect that there are going to be more regulated players like yourself at some point?
We really always expected that if we got to where we are now, we're going to have a lot of competitors, and we welcome competition. I think there's a lot of ideas that come from other companies. A lot of what we do is we look at who are the best companies at XYZ and what can we learn from them. And I think that having people directly doing things in our industry, we're going to be able to learn a lot. And I think that it's going to be better for consumers at the best end of the day, because they're going to have the best prices, the best experience, the best UI, all of that.
Yeah. As someone obviously who works at a media organization, I'm really curious about the partnership that you guys signed with CNN. With that partnership, that's the first news partnership I think you guys have announced. And tell me more about sort of how you see prediction markets interacting with news and what you're hoping to achieve through that.
One of the most interesting parts of prediction markets, and I think one of the one that benefits the world the most, is the forecasting data that comes from it. So for background, markets are good at two things. Markets are very good at aggregating information and incentivizing better information to be discovered, right? So if I poll my entire office and ask if it's going to rain tomorrow, I'm going to have a better answer than if I just ask one person. And on the other side, if I say, I'm going to give $100 to who gets this right, people are going to be like, oh, let me search what's going to happen. Let me look outside and all those things. And that's what markets do. They incentivize people because they're going to put money where their mouth is. You're going to put money there, so you're going to be thinking about it, you're going to do your research. But then you're doing that with millions of people and aggregating that into a single number, which is the price. Markets are very, very good at pricing things. And with that, they're also very, very good at pricing the future. And this number is just a way better forecast probability distribution about what's going to happen in the future. And what we see this is really as a way to like augment the news and engage the audiences more by showing another data point of how you can like make sense of the world that's happening around you, right? Like if there's a lot of coverage about what's going to happen in, for example, the next election, but like what are the actual numbers for the candidates? What are the actual odds that AOC would win or Gavin Newsom or JD Vance? And you can actually track those with time and really engage the audience in a new way. And that's why we're very excited to partner with the news. And again, it's like going back to the topic of distribution, this time is not the distribution of the trading itself, but it's the distribution of the data, which is also very important. It's like getting more and more people to look at the data, understand it, so that hopefully we get more people to understand what probabilities are.
Yeah, I feel like you could almost place what is happening with prediction markets in part of this broader sort of digital shift to having financial outcomes tied to your sort of online behavior or your online opinions in some way. If I think about even like on TikTok, you can go, if you go viral with a really hot take and people really like it for whatever reason, you get more views and then you might get more money, right? And there's like this connection between sort of financial incentives and opinion that I think is really interesting right now. Mm-hmm. Yeah, one thing that I'm kind of curious about is it feels like, yeah, there's in a way, obviously, though, that TikTok opinion doesn't have to be true, right? It can just be the wildest theory out there. And that's sort of why we see some of these like extreme views right now. It seems is that, there's incentives on a lot of platforms right now, if you think about social media algorithms, to have a sort of more extreme take.
Right.
Whereas like prediction markets in a way feel like the opposite of that.
Exactly.
Is that one way to sort of think about what's happening here?
100%. Prediction markets really are this antidote to like social media is about engagement farming and the rage baiting and all those things. And you're incentivized to just like have extreme views or whatever is going to get you to go viral. But markets are the opposite. They incentivize you to be right. It doesn't matter if you have a crazy take or not. What matters if you're right, you make money. And that's just such an antidote because you open your Twitter, like you don't know what's right? Like you don't know if you're reading a right thing or if you're TikTok, if you're saying the right thing, is this right? Is this wrong? But with markets, you can trust markets because people are putting money where their mouth is. And then when they do that, you can trust that people want to make money. So if people want to make money, they're going to try to be right. And this you can price that a lot better. And I think the other part of what you said that is right is like on the more that's where we're very different from social media, right? We're the complete opposite of social media there. We incentivize truth. We don't incentivize engagement or clickbaity and things like that. On the side that we're more similar, as you said, is like social media has been very empowering, allowing people to make money in alternative ways and make money on what they're excited about and their hobbies and all of that, which is very similar to Kalshi in a way. Like everyone is an expert on something, and Kalshi is a great way to capitalize on your knowledge. And, if you're one of our biggest users actually is an Ariana Grande super fan. He's been a fan of Ariana Grande for forever and has had this Twitter account. Anyway, massive. Found Kalshi for the election, wasn't really interested in the election market, but started trading our music charts. And now he's made over $70,000, paid back all his student loans, he bought a car and everything. And I think that's another big part of the power of markets and why markets work, is that if you're right, if you're good, is a way to make money once you know.
Yeah, I know your co-founder has talked about sort of this like financialization of everything. And I mean, there are folks now like your partner Coinbase, talking about, I forget the language that they're using, but, they sort of want to be this like everything market. Mm-hmm. And is that sort of where we're headed? And is your focus always going to be prediction markets? Like, how do you sort of draw the bounds, especially as, people are sort of building these sort of like everything shops for trading everything, I guess?
Right. So I think what we mean when we say we want to like financialize or like create markets out of things really is that we want to bring more truth to the world. And markets are very good, as I said, as aggregating information, incentivizing right behavior, and becoming a very good forecast for the future. And we think there's a lot of great questions about the future that you should be able to price and get better information on. Of course, there are things we'll never do, like as I told you, death, terrorism, assassination. We will never do those things. And that's not what we mean by that. In terms of what our plans are, mm-hmm. we really believe that like prediction markets are the best and like ultimate way to trade, because you can really trade on anything that's going to happen in the future. But we actually have a way broader view of what prediction markets are than what we have what's on Kalshi right now. So for example, one clear example is prediction markets don't actually have to be yes, no. They are yes, no, because that's the structure that we have right now. But you can have linear prediction markets, or prediction markets that are structured as a future, or prediction markets that are structured in a lot of different ways. And that's a lot of where we want to go towards. We'll never change from allowing people to trade on anything that's going to happen in the future, but we're going to build a lot more market structures, a lot better systems, and a lot of different ways to interact with that, which is going to be a lot of our focus in 2026.
What's it been like for you to kind of be on this roller coaster riding the markets yourself? You're now, I think, the youngest self-made billionaire woman that we have here on the planet. So that's pretty exciting. I'm curious, like, what do your family in Brazil make of this? And what's it been like for you?
Honestly, it's been surreal. I'm very, very grateful, obviously, to my family. I have the most supportive family in the world. Since I was very little, they always taught me there's no limits to what I can do. And I think that's really helped me just be very ambitious and try to do as much as I could do. But I'm very grateful for, the employees and the investors and everyone that helped the company get to where it is. It is really, really a dream come true. But in reality, nothing changes. We're still in the office 14, 16-hour days. It really feels like day one here. We're trying to ship so many things. So many things are delayed at this point. We just need to ship a lot of things before the end of the year and continue to try to do the best product possible next year.
Well, I feel like I should let you get back to work then. But thank you so much for taking the time to talk with us.
Perfect. Thank you so much. Thank you for having me.
Thank you.
Okay, we're back, and it's time to wrap up the show with Keeping Tabs. This is where each one of us shares a story, trend, or piece of pop culture we're following right now. Kristin, it's just us. It's your first time guest co-hosting.
It is.
You've been on the show a few times.
I have, yeah.
You're going to be here once a month going forward. What are you keeping tabs on?
I am keeping tabs on some very low-stakes drama, which I think is a great counter to everything in the news right now, which is Ashley French, formerly known as Ashley Tisdale's mom group drama. Have you seen this?
I sent this to Yaz, your normal co-host, who's on maternity leave after. I'm still sending her work-related stuff, which is not great.
Stuff somewhat relevant now.
Mom group stuff fairly relevant. I read this. Go on though.
Well, it's that perfect low stakes. It doesn't really matter drama, but it fuels so many. There are multiple Reddit threads about this, multiple articles about it already. Basically, for anyone who doesn't know, Ashley French wrote an essay for The Cut about quitting her toxic mom group. She didn't name anyone in the group, but she talks about feeling left out and confronting these people and it sort of feeling like high school. And then, of course, the internet did what it does, which is found everything about it that they could and found that Hillary Duff was probably in the group and Mandy Moore was probably in the group. And it all just went off from there. I don't know if you saw, but Hillary Duff's husband got involved with this as well.
Is he a hockey player?
I don't know. I think he's chronically online now is
he?
The thing.
Oh, God.
He posted to his Instagram story a fake screenshot mock-up of an article for The Cut with a picture of himself in the exact same pose as Ashley Tisdale, with this fake headline that said, "When you're the most self-obsessed, tone-deaf person on earth, other moms tend to shift focus to their actual toddlers." And then a subhead said, "A mom group tell-all through a father's eyes." So even the dads are getting involved, which I think says something about this.
Honestly, I read that and I thought, man, Ashley Tisdale, or Ashley French, as she's going by now, that's her husband's name, is perfect for reality television from the Housewives series.
Well, mom drama famously great for reality television.
For
the Mormon moms,
dance moms,
yeah,
all of them.
There's a whole mom.
There's a whole mom franchise sort of go-to verticals within reality television. Oh God, yeah, Ashley. I feel like my takeaway from that article is just maybe they just didn't like you that much.
I know, to make a whole essay complaining about being left out.
It's very High School Musical.
Yes, it is very High School Musical.
And it's fine. There's going to be a mommy group that does like you. It's going to be fine, Ashley French.
It's also very celebrities. They're just like us. You know? It's one of those moments. Anyway, what are you keeping tabs on?
So we talked a little bit about CES where Nvidia made a big announcement earlier. I love CES. Like, it's a who's who of useless gadgets. There's some really cool stuff that happens at CES, but there's so many gadgets and electronics that are on the floor that you'll never hear from again. Occasionally there's something that comes up where I'm like, I have to buy that. And this year it was a new smart dog crate from, I think it's called Clever Canine.
Okay.
That basically you can automate a bunch of functions to like keep your dogs happy, make the door open and close, automate food and water and entertainment and lighting and all of these different things.
Are there screens for your dogs?
There's screens. There's screens in there. There's a privacy like frosted glass door on there for your pup in a bed. They're going to cost between $600 to $2,000.
Oh my gosh.
I want to get one for my dogs so bad.
But my fear with that is like, say the app is on the fritz or something
then
goes wrong and your dog is stuck
crate.
in there.
Oh, yeah, that's true. There's got to be some fail-safes.
That makes me scared to trust it. Oh, I would hope.
Yeah, it does have some functions where, I mean, it was like if it senses carbon monoxide or fire, it will open the doors and let your dog out. And I was like, oh, that's cool. Then what? Then what happens to my dog? Because I live in an apartment. It's not like my dog. I suppose if you have like a doggy door, and you have a backyard, and your dog, and you're not like a New Yorker with a single point of entry on the 6th floor.
But I guess it's not you trying to find the right app when you're also trying to leave for the fire.
Yeah. That is also true.
Yeah.
Anyway, so I will drop a bunch of money on a smart crate for my dogs at some point.
Everything is smart now. Everything is too smart, I think.
I know the horror films that have come out about smart houses and houses taking over, or Megan or whatever have you, but I'll make my whole house smart. It's fine. I feel like the technology's still a long way away. Like Alexa still can't tell me the weather correctly most of the times. So I think we're fine.
Okay. As long as the dogs are safe.
I think it's a good place to leave it. That's it for Most Innovative Companies. Thanks, everyone, for listening. Kristin, thanks for guest co-hosting for the first time.
Thanks for having me.
Our show is produced by Blake Odom, Sam Gebauer, Hawa Atori, and Miriam Kiparuitse. Editing by Matt Toder, mix and sound design by Tad Wadhams and Nicholas Torres, and our executive producer is me still somehow. Remember again to subscribe, rate, and review, and we'll see you next week.